Hey everybody, Joe Pellegrino from Robbins Pellegrino, a business brokerage firm. On today's recording, Chandler and I talked specifically about getting your financial records together. A lot of business owners don't realize that they don't need to overthink this part of the process. And so we outlined pretty clearly what all you need to get the listing process started, to get the valuation process started, and some of the pitfalls to look out for, some of the things that will actually show you that your business is worth more than you ever thought. Most businesses, their cash flow is actually significantly more than you think it is. And so we're going to kind of talk through all that stuff. You're not going to want to miss it. We'll see you over there. All right. So one of the things that we see, anybody that comes through our door, anybody that's looking to sell their business, financial records are an incredibly important part of the whole process. We talked about valuations a couple weeks ago, and we talked about how that really is the starting point. But even before you get a value, in order for us to value your company, we have to understand what your financial standings are. And there's some things that we really need to see in order for that to be the case. So Chandler, why don't you talk through a little bit about what kind of financials are we really looking for?
Sure. So really, and this is what I tell everybody that asks me, I want to see your financials, right? So first starting point is just whatever it is, let me see it, right? So it's confidential between yourself and your broker. So it's not like I'm going to go share it to the world. I'm not going to judge you personally on your business's health. But I need to see what the business is doing so that we can have an intelligent conversation. But really, in terms of evaluation, what's needed is end of year P&Ls. So, and really the last 3 years. So right now we're in 2024. So everyone's finishing up year end for 2023, but I would review those 2022 as well as 2021, and then a balance sheet, a current balance sheet. And then sometimes I go for 3 years of balance sheets, depending, so I can see what's going on there too. That's really, I can do most of my work with those documents. A lot of sellers ask me, well, do I need my tax returns? Maybe at some level for the due diligence process for the potential buyer once we're under contract, maybe for a lender. But for me up front, I don't need a tax return.
Okay, and why is that? Wouldn't that be an important document to
It,
prove?
it, it is an important document, but I own businesses, you own businesses, Joe, and really the IRS, what a tax return is it tells you how well or how not so well you are at giving the government dollars, right? So it's not it doesn't represent the health of your business, because hopefully I'm seeing a lot lower threshold on your tax return than I am in the P&L or kind of what's going on in your business. It's just, that's a tax document, and hopefully your CPA and you have mitigated your risk on that tax document. So I don't hold as much weight to it. However, lenders, and we want to make sure they're comparable, right, during the due diligence process, but I don't use them for valuation.
It's really interesting. That's really interesting, but it's equally interesting what you were saying earlier about we want to see your financial doc. We don't want to see them doctored, played with. Oh, I got to make these look better before I show them to Chandler. That's not the case, right? I mean, we want to see what's going on in the business, because if you're going to sell the business, what's going on in the business?
Right. If you haven't been, let's say you pretty up your financials, and you did that for your broker to give you a valuation, but you're not running it that way. It makes it very complicated for me to show patterns and growth, or to answer any question around those financials if you've just prettied them up just for me to see them. Instead, I'm looking at the previous 2 years and they're a jumbled mess, right? So I just like to get it however you're doing it. And then I work along with you and your CPA to kind of get to a finished project so that I can review them in whole.
Do you recommend generally that a business owner that's about to enter into this process, do you recommend that they talk to their CPA before they send us their records, or if they have their records, they just send them over and then we'll deal with other stuff later?
Either way, it's not going to hurt my feelings. I mean, I think generally a CPA is going to know some of those things that need to be course corrected, and they may do some of that legwork. But again, I'm not the IRS. I'm also not a CPA. I'm looking at different things. So again, where CPAs might try to mitigate your risk, I'm looking for how do we boost that cash flow, that EBITDA number, right? Because I'm taking that number and multiplying it by a certain multiple per your industry to give you your worth, right? In short, that's basically what I'm doing, a good rule of thumb there. So I say if you can clean it up a little bit, great, do that. If not, don't worry about it, because oftentimes I'm going to have questions for you and your CPA anyways, and we can just do that work together.
Yeah, yeah. So realistically, prospects and really anybody that's looking to sell their business and about to start working with a broker, you don't have to worry about getting to a place where everything is perfect and in line. Just send us what you got, and that at least gives us a starting point. Because there will be clarification questions, right? We actually have a call right after this recording, right, to ask clarification questions of a client who has given us their financials, and we need to kind of dig into that. But the thing that also business owners need to understand is the level to which we take confidentiality seriously. That's an industry standard, right? And
Sure.
any business broker is going to take confidentiality extremely, extremely seriously. So, in before you send us your financials, let's get that NDA done, right? And you can access our NDA and sign it right through our website. But at the end of the day, this whole thing is protected. So just send us what you got, right? Don't hold back. Send us what you got, and that's going to at least give us a starting point to understanding what's going on in your business. Because, like you said, Chandler, it's not about like sending us your financial documentation is not about, it's not for the sake of doing it, right? It's not to certify you in any way. It's not. That's why tax returns. We're not worried about that. We're looking at like what's going on in the business.
Mhm. Yeah, but it helps me to establish whether you are marketable to the general market, right? And there's different levels of that. There may be
Yeah.
some work that we have to do. We may have to get there, but ultimately, I just need to see what the business is doing. Dollars in
Yep.
and dollars out, right?
Yep. Dollars in and dollars out. That's the whole thing. So, what are some of the things that? So actually, one of the things that we see a lot, because we run campaigns digitally to bring in business owners, and we ask them a few basic questions to qualify them. And one of the questions that we generally ask is, what is your cash flow? And no shame whatsoever, but a lot of business owners don't actually, first of all, they don't understand that concept. Well, they don't understand exactly what we're looking for, but then in a lot of cases they don't know that number off the top of their head. So can you clarify what specifically we're looking for when we say, what is your cash flow?
Sure. When I ask a business owner for their cash flow or their EBITDA, I'm looking for that number, that net profit at the end of the year, when all the way down on your P&L sheet, and it's either going to be a positive or a negative. And then that number grows or shrinks depending on the level of add backs, which we're going to talk about here shortly. And then I use that to adjust that cash flow or adjust that EBITDA to give a truer sense of what the cash flow really is, because any dollars that you spend on a non-business related expense is an add back that we can throw back and ultimately make your cash flow larger.
But for all intents and purposes, if I'm a business owner that just is about to fill in a form to get the conversation started, the number
It's
that we're really looking
that
for is,
net profit at the very bottom of your P&L after 12 months of running of operations.
yep.
Yeah.
Fantastic. Yeah. And that's it, it really is as simple as that. And again, that gives us
It
that
just
gives
get
us
the
an idea.
foundation, because
Mm-hmm.
everybody's cash flow is pretty much, I can guarantee you it's always larger, sometimes by 5%, sometimes by 50% based on the add backs. But that's a great foundational piece to start.
Yeah. So what are some, let's talk about ad backs, right? So,
Sure.
I think a lot of business owners are relatively familiar with that term, but what are ad backs, and then what are some things that can be considered ad backs?
Sure. Very quickly, add back is just a non-business related expense. So that's anything that the business pays for that is not actually related to business or necessary to the operation of the business. So one of the largest add backs that typically comes in is when a seller gives themselves an officer salary, right? So I do want to be very clear that if you are the owner operator of your business, let's say you own a pizza shop and you are in the pizza shop 40 hours, you can't add back that salary because that anybody else would need to work there 40 hours. But if you pay yourself, and if that normal salary is 40,000, but you pay yourself $80,000, then we can add back a portion of your salary. That's about 40,000 if you're paying yourself 80, and the normal rate would be 40. But let's say you have nothing to do with the operation of your business and you just collect an officer salary or an owner's salary, that would get added back. If you pay your health insurance, right? If you pay car insurance or your car payments or your gas or food or anything that if you bought, if you bought your family 5 laptops and you use the business card, we got to notate that. Um, Meals and entertainment, that's a pretty common one that everybody knows. But if you put up trips on the business card and you pay for it, then we can add those back. Those are pretty common ones. Big purchases. So if you are, let's say you're a construction company, and you buy 5 new dump trucks, in 2023, this past year. If that's not an ordinary expense, then you can add that back, right? And if let's say you own the real estate of your business and you put on a new roof, and you don't typically do a roof every year, you could add that back. Any one-time expenses or any business related expenses can be add backs. So they're kind of in two categories: one not related to the business, or one large time expenses that aren't typical.
And I think those are, especially in the home services and construction industries, where you know these guys are, business owners are buying trucks, they're buying that are their own, right? They're not necessarily associated with the business, right? There's a lot of that happens. And so, like you said, I mean, virtually every business, their cash flow is going to be greater than what's stated on their P&L. But it's like, I mean, we have a listing right now where there was a tremendous amount of ad backs. I mean, 7-digit ad backs.
Sure. Yeah. Oh, there are often times where I can find a $500,000, $1 million. It just depends.
Yeah.
So it depends on your philosophy as you as an operator, and maybe as your CPA. Some CPAs allow their business owner to do more of that than others. There's no right or wrong. I will tell you this, and this might be a conversation for a different day. Another thing, I'll tell you what's not an add back. So let's say you take an owner draw. So you take dollars out of the business and you put them in your personal bank account. That is not an add back. That goes over on the balance sheet, which is why I often look for those. And I give credit to that. But if you're trying to position yourself to sell, kind of a rule of thumb is go ahead and take a larger salary that's on the books, that's on your P&Ls, not showing up on the balance sheet as a liability, so that I can add that back and then increase your cash flow. I don't have that same liberty when it's over on the owner draw side on the balance sheet. Also, lenders are going to love to see that on the P&L side, and are not going to love to see a large owner draw on the balance sheet, because they can't give any credit to that. I can as a broker, but lenders are going to value your business on whether they are able to lend money to that for a potential buyer based off what the P&Ls and the cash flow show. Now, if you took a $500,000 owner draw, that's going to hurt you.
And why is that? Why is that so different from salary?
Okay, this is a very, very kind of oversimplified explanation. But let's say your company made $100, and you had fixed cost of $20, and part of that was your salary, which was another 20. So now and we got another, anyways, all in, all your expenses are $50. So you made $50 from that 100. I can show that there is lines in the P&Ls. There's a kind of a written history. Now, let's say we go back to that. It's the beginning of the year, you make that $100. But then you go and take $50 before it even hits the bank account, and you go put it in your bank account. Now it looks like your business made $50. Now you have that same $50 of expenses. You've now made $0, but you're hanging out with a $50 bill over here. That $50 is real and you can use it, and that's an owner benefit of owning a business. However, I can't value it there because it wasn't revenue, it wasn't income. You took from the business, and you can't double dip. You can't take and give credit to the $50. You can either take your $50 or you can credit it over here as an expense, but you can't do both.
So realistically, if I'm a business that is maybe not ready to sell today, maybe I'm thinking 2 or 3 years down the line. These are things that I really need to be taking into
Well,
consideration.
100%. If you want to sell within the next 24 months, then you need to have a conversation with your CPA. You need to have, I'd love to have a conversation with you. I'd love to have a conversation with your broker, right? Because the valuation piece, I can tell you, hey, listen, this is where your value is now. If you do some of these corrective actions on your P&L, it may raise your value 20 to 30%. It's also going to make you much more attractive lending, and lending right now is picky. It costs more money to lend right now, and therefore you want to present your business in a pretty bow, in a pretty package, rather than kind of making it difficult for them.
Mhm. Makes a ton of sense. What are other potential, liabilities or red flags that could be that we as business owners need to look out for on our P&Ls if we're preparing to sell?
So I would say really the lack of everything that happens in your business, every expense, every piece of income, show it, right? So if similar to our conversation with the owner draws and taking the 50 and having it over here and then not expensing it out, if you are not thoroughly explaining that you spent $100,000 on trucking equipment and it looks like it was just miscellaneous, I
Mm-hmm.
don't know what to do with that. So definitely give every large expense, give it a line item. Tell us what it is, right? That can be a trap. Overpaying, everybody wants to give themselves a really nice salary. You want to give yourself a reasonable salary per industry standards. Anything above that is also going to cause some issues, especially if you're an owner operator, because what is an expense to the business is whatever job that you're doing, right? So if you are actively involved in it, there's a finite piece of, that amounts to X dollars a year. And then whatever's above that, you can add back. But you can't just say, oh, I give myself $150,000, so I'm going to add it all back. Not if you are necessary to the business. So some people get trapped with that, giving them an inflated um, uh, salary and then expecting all of that to be added back. That doesn't work that way either.
Well,
Um,
some of the other ways you look at it, right, is where you'll give a lower multiple to pieces of the to pieces of ad backs, right? Like that's something we did with the listing recently.
Yep, sometime. Well, I gave a lower multiple due to they had a really large owner draw, which is over here, not on the P&L side, over on the balance sheet, and it was so large, it was 6 digits, high 6 digits, that I felt the need to give some value, but it makes my job harder and ultimately may end up lowering that value. Right, that is not best practices for selling, and had to make the seller aware of that. Right, so. Um, if you're looking to get top dollar, you want to go away from owner draw and into salary.
So, okay, so we kind of know what's necessary to get the process started, right? We need to be able to provide 3 years of P&Ls, recent balance sheet. Um, what kind of comes next in the process, right? So these are really all the things we need to generally get the business valued and ultimately listed. When it comes time for due diligence, what are the kind of documents that we're going to have to? Is that really where taxes are going to come into play and tax returns are going to come into play, or what do I need to expect as a business owner?
So think the due diligence period, which is the time once we've gone under contract, once we've identified a buyer, we've gone to contract, we've signed it, and it's day one, right? And now that potential buyer has entered their due diligence period, and that ranges from 15 to 30 to 90 days, depending on what the transaction is. What's involved there is basically that the potential purchaser wants to learn all they can about your business. So this is where if you haven't provided historical data for your financials, 2022, 2021, you're going to provide that. You're going to, maybe if you gave a high level P&L, maybe you're going to give a more detailed P&L. You're going to get a list of assets. So fixtures and all of that. Let's go back to that construction example. If you owned a trucking company and you had 12 trucks, we're going to want to know what year and model and how many miles and a lot more specifics, right? So your organizational structure, who's in charge of what, how much staffing you have, a lot of deep, are you what services you offered and how you offer them, and kind of how the business operates and any supporting documents that go along with that. Some of that's tax returns, but again, depending on who is on the lending necessary, those have a varying level of importance.
One of the things that we've heard in the past is, prospects saying, well, should I keep separate books? Like almost like keeping books for Uncle Sam and keeping books for prospect of selling. Where do you kind of fall on that?
Great question. So I tell everybody often I am not the IRS, right? I'm your broker. My sole job in life is to make sure that I manage your expectations and ultimately get you the highest price you can for your business. So with that said, when I'm looking at your P&Ls, when I'm looking at your financials, I want cash flow, and I'm doing everything I can to manipulate those in order to give you the largest cash flow. And often I'll say, well, I might make $200,000 on paper, but I've got 200,000 I'm making cash. So if the conversation ends there and it's just, hey, I make another 200,000 in cash, that can be hard. Especially if there's zero paper trail. But there are many instances where if you keep a journal or a separate notebook, and I see that, and I can clearly show that to potential buyers, and you're okay with that, the potential seller's okay with that, that I can give that credit just as if it was on the P&Ls. So as long as you have written support to back up the fact that you make X amount in cash and can show it, we can use it. If we can't verify it, then we can't use it.
Now, we obviously don't condone one way or another, right, for the sake of tax purposes. But at the
I
end
mean,
of
I
the
don't care
day,
because I'm not, I'm
right,
not,
right,
I'm not the tax, I'm not the IRS. I don't care.
exactly,
But if
exactly.
you,
We
you
good.
know, you got two books, bring both
Show
books
it
to
all.
the
Yep.
table.
Mm-hmm.
Yeah.
Yep. No, makes a ton of sense. Well, good, man. I mean, I think in terms of what's necessary, it really is just it's simple, right? And as business owners, we simply need to see what's going on. We simply need to see what's going under the hood. Otherwise, we can't get you the best value. Otherwise, we can't get you on the market. And as we say, we're not going to list you unless we think we can sell you.
Right,
And we're
right.
not going to list you
And
unless we
that's
think we can sell
a
you.
twofold statement, really. We've got to feel the need that we can position you in the market, that you sell at a price that the seller's going to enjoy, and that your business is prepared enough to sell. That when I'm looking at your P&Ls, that there's a healthy business, that you are running the operation correctly, and there's some give and take with that, right? Each owner operates a little bit differently, but there's some rule of thumbs, right? If I look at your staffing cost and it's 30% higher than all your competitors, then I'm having a conversation with you that we've got to get that lower ahead of selling so that we can ultimately increase the profitability and increase that transaction price, right? Um,
Yep.
so for sure.
Fantastic. Yeah. So if you are interested in exploring what it looks like to sell your business, exploring what your business might be worth, and you make at least $2 million annual, I should say, and you do at least 2 million annual revenue, we'd love to talk with you. And that's something that we do at no cost generally, as long as you qualify. And all you need to get started on that is to request the NDA, to get that process started, and submit your financials. And it really is as simple as that. Don't overthink it. If you're thinking about selling, it doesn't hurt to try and see what your business is worth and what we think we can list it for. So if that's something of interest to you, robinspellegrino.com, and we'll see you on the other end of that. Chandler, thanks, man, for this conversation today. I think it was really helpful just to sort of, you know, turn over some stones and just kind of understand a little bit more the depths of what's necessary from a financial perspective. Is there anything you want to add before we wrap up?
No, I think I would really just tell anybody looking to sell is there's not a wrong answer, right? I'm not your kindergarten teacher. I'm not the IRS. Essentially, I am on your team. I'm on your side. I am looking at your P&Ls, looking for dollars to add back, looking at your profitability so that I can get that wonderful sales price that you're after, right? So just it's not scary. It's also doesn't obligate you to anything. But I definitely, we all know it. Knowledge is power. And if you don't know the value of your business, you simply can't sell it. So that's really our starting point. So that would be my advice to anybody.
Fantastic. All right. Well, thank you, Chandler, and we'll see you guys next time.